Welcome to the deep dive.
Great to be here.
Okay, straight into it today. We're looking at this piece from the Motley Fool, just out yesterday, May 5th, 2025.
Right. The one titled 3 High-Yield Dividend Stocks to Buy Now and Hold for the Next 20 Years.
Exactly. So our mission is to really, dig into why these three stocks, Brookfield Infrastructure, Omega Healthcare Investors, and Realty Income are getting flagged.
Yeah, flagged as potentially solid long-term income plays, they all had dividend yields over 4% when the article dropped.
Which, for you listening, if you're thinking about reliable income, especially over a long time frame like 20 years, this is definitely worth paying attention to.
Absolutely. And, in markets that can feel a bit choppy, that idea of consistent income from dividends, it's pretty appealing.
So we're going to break down the arguments for each one, look at what makes them tick, why they might be solid anchors for your portfolio over the next couple of decades.
Exactly. What's the underlying logic?
Okay, let's unpack Brookfield Infrastructure first. The article paints them as a big infrastructure investor, really diverse portfolio.
Yeah, we're talking utilities, pipelines, data centers, transport assets, all over the globe, too.
So what strikes you about that kind of diversification right off the bat?
Well, the immediate thing is the stability that comes with it, right? They're not tied to just one sector or one region, different parts of the world, different types of essential services. It gives them a pretty robust foundation.
Essential services being the key phrase there.
I think so. People and businesses, they need power, they need data, they need transport, pretty much regardless of the economic climate.
Right.
And that leads to what the article highlights as a key advantage, predictable cash flows.
Okay, predictable cash flows. That sounds good for dividends.
It's crucial. It lets them plan long-term, invest strategically, and, well, it probably helps them ride out downturns better than companies with more volatile income.
Makes sense. The article also mentions long-term contracts and government-regulated pricing, adding to that predictability.
Yeah, it reinforces that idea of a model built for steady, reliable earnings.
And the dividend itself, they mentioned growth of 32.7% since 2020.
Which is pretty strong growth.
And a current yield, as of the article, of 4.5%. That's a decent return for you as an investor.
It is. And they back this up with recent numbers. First quarter 2025 FFO, that's funds from operations, was up 12% year over year.
FFO. Remind us why that's a key metric here.
Right. So FFO is often used for REITs and infrastructure firms. It gives arguably a clearer view of operating cash flow than net income because it adds back depreciation and amortization, which can be significant for companies owning lots of physical assets.
Got it. And that 12% growth came from rate increases and acquisitions.
Exactly. Shows they're not just sitting still. They're actively growing their operational base.
And they're investing heavily too, right? $730 million in growth capital expenditures in Q1 alone.
Yeah, that's a big number. It suggests they're really focused on future expansion.
But they still have cash on hand.
Oh, yeah. The article mentions $4.9 billion in liquidity. So they're investing in growth, but maintaining a strong financial cushion.
So how does that combination, investing plus liquidity, paint the picture for the long term?
Well, it signals that commitment to creating value over time. The article calls it their time-tested strategy for steady gains.
Time-tested strategy.
Basically, keep investing in and managing those essential assets that people will likely need for decades to come. That supports the dividend.
Okay, solid case for Brookfield. Let's shift gears now to the second one, Omega Healthcare Investors.
Right, OHI. This one's a REIT, a real estate investment trust.
Focused on healthcare facilities, mainly skilled nursing and transitional care.
That's the bulk of it, yeah. About 30% is also in senior housing.
So what's the fundamental investment thesis here? Why Omega?
It really comes down to demographics, a big unavoidable trend, the aging population.
The demographic wave.
Exactly. The article points to U.S. Census data from 2020-2023 showing a significant jump in the 65-plus population pretty much everywhere in the U.S.
And more older adults means?
More demand for the kinds of facilities Omega owns and leases out, skilled nursing, senior housing, it's a direct link.
Seems logical. And their portfolio is quite large, nearly 1,000 facilities.
978 operating facilities, mostly in the U.S. 42 states, but also some in the U.K.
Okay. And the article mentions they use net leases. Why is that specific model important for their stability?
Good question. So for you listening, a net lease basically means the tenant, the company operating the nursing home or senior living facility, is responsible for most of the property level costs.
Like maintenance, taxes.
Exactly. Maintenance, property taxes, insurance. Those variable costs fall on the operator, not Omega.
So Omega mostly just collects the rent.
Pretty much. It leads to, generally speaking, more predictable cash flow for Omega because they aren't hit by unexpected repair bills or rising property taxes directly on those specific properties.
Interesting. Now, the pandemic must have been incredibly tough for these types of facilities.
Oh, undoubtedly. Huge challenges for the operators and the sector.
Yet, the article notes Omega kept paying its dividend right through that, maintained it since 2019. What does that suggest?
It definitely suggests a level of resilience, when you say, both in their model and their financial management through a really difficult period.
And the yield now is quite high.
Yeah, 7.2% according to the article. That's a pretty significant yield.
But is it sustainable? What about covering that payout?
Well, management's projections for 2025 adjusted FFO are between $2.95 and $3.01 per share.
Okay.
And the current annual dividend is $2.68 per share.
So the projected FFO comfortably covers the dividend.
Based on their forecast, yes. That suggests the dividend is, reasonably well supported looking ahead.
All right, compelling points there too, especially with that demographic tailwind. Let's move to number 3, Realty Income.
Ah, yes, the Monthly Dividend Company.
That's their tagline, right? Another net lease REIT, but wow, the history here. Started with one Taco Bell 50 plus years ago and has increased the dividend consistently.
It's a largely yes, and service-oriented retail too. It makes their rental income stream more reliable.
And they have a lot of properties, over 15,000.
15,621 buildings mentioned, but crucially, those top 3 tenants only make up about 10% of the rent.
So good diversification even among those stable tenants. Not too reliant on any single one.
Precisely. It spreads the risk.
You mentioned their access to capital. The article gives an example, borrowing $600 million recently.
Yeah, back in April 2025, they borrowed $600 million for 10 years at 5.3%.
Which, in the current environment, seems like a pretty good rate, doesn't it?
It certainly highlights their ability to tap into funding at favorable terms, thanks to that credit rating. That helps fuel growth, buying more properties.
And is there still room for them to grow?
The article suggests so. It touches on the idea that the overall market for net lease real estate is huge, and there's still a lot of potential space for companies like Realty Income to expand into.
Okay, so let's pull this all together. 3 companies, 3 different angles on high-yield dividends.
Right. We have Brookfield Infrastructure at 4.5%, focused on those essential global assets.
Then Omega Healthcare Investors, higher yield at 7.2%, riding that big demographic wave in healthcare real estate.
And Realty Income at 5.7%, the steady monthly dividend payer focused on resilient retail tenants with a long track record.
Different sectors, different business models.
But the common thread, and this is key for you listening, is that focus on generating reliable, predictable cash flow.
That's the foundation for the dividends.
Absolutely. That consistent cash generation is what allows them, theoretically, to pay out those dividends consistently over the long term. That's the potential appeal for your portfolio.
Now, we always have to add the caveat, don't we? Past performance.
It's not necessarily indicative of future results. Standard disclaimer, but important.
Right. But the factors the article highlights the nature of infrastructure, the demographics for healthcare, the tenant quality for Realty Income. These do build a case for their long-term potential, as argued by the source.
They provide a rationale beyond just looking at the past dividend history.
And thinking about that 20-year horizon, the article suggests, the power of compounding those dividends, if you reinvest them, that could be really significant over time.
Definitely. It's a core principle of long-term dividend investing, that reinvestment can dramatically accelerate wealth building.
So a quick recap. Brookfield Infrastructure, Omega Healthcare Investors, Realty Income, 3 distinct paths potentially leading to long-term dividend income, according to the Motley Fool article.
Each leveraging reliable cash flows from infrastructure or specific types of real estate.
Which brings us to a final thought for you, the listener. We've looked at infrastructure and real estate here, thinking about generating reliable long-term income. What other sectors out there might offer similar kinds of opportunities?
Yeah, and maybe more importantly, what specific factors or characteristics would you prioritize when you're looking for companies that could potentially provide that kind of dependable income stream for decades to come? Something to think about.